So we go from all green to some tail, but mostly green. Then we go to half tail, half green, and then we go to all tail. Now, when a green, when a green bar, a fat green bar, extended well above its key moving averages, fat green bar, well above its key moving averages. When if that fat green bar gets removed, and we just established that this fat green bar was was completely eventually removed to produce that bar. Boom, boom, boom. That's when we jump into that bar with a short position and a protective stop above the high of the bar. Why are we betting to the downside? Because we're betting that this far distance away is now going to be brought back to near. And that's all markets do. They start off just like this, guys. Check this out. They start off near. Here's near. They move away. Then they come back near again. See, we're back to near again. And then they might act near again. And then eventually they'll move away again this way, or they'll move away again that way. You can move away up, or you can move away down. And you can gap yourself far away too, as Baba did this morning. Baba didn't trade away. It gapped itself away. All right. It gapped itself away and then produced a nice fat red bar, a nice fat green bar. Sorry about that. We'll make sure that's green. And this bar was eventually removed. Little by little, little by little. And when all of the green was gone, boom, we just drill the stock for a short on the erasure or the removal of green far away from the key moving averages. That short there with a stop or protective stop above the high of the day in this case, or above the green that was removed, and the rest is basically history. Now, I've taught you the color game. If you continue to play the color game, not only are you shorting here on this removal of green far away. Remember, this is the concept that I'm teaching you today. The removal of green far away from your key moving averages. I'm going to repeat that 2 more times. The concept today, the removal of green far away from your key moving averages. One last time. Let me come up real nice and close for you, okay? The concept today, fat green, far away from your key moving averages. The removal of green far away from your key moving averages. Boom! We watched the green disappear 25%, another 25%. Now it's half tail, half green, 75% tail, 25% green. Saliva begins to drip down the corners of your mouth. You get ready. All green gone. Boom! 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 You know the deal. We get excited about these moments, right? That's our moment to strike. Protective stop above the tail. That's the concept. So many traders, guys, check this out. I want you to understand this. Do you understand? Can you imagine how many traders got stuck and Baba right there on the buy side, on the long side, because they don't know this concept. They're hanging from this pole, still waiting, guys, still waiting and hoping that Baba comes back. They bought that green right there, thinking, believing that Baba's good news today, Baba's strong opening today was going to continue. You know that this far away from your key moving averages has low odds of continuation. You now know that if this green here disappears, if that green disappears, you know, boom, that is your strike moment. You also know to protect yourself, should this not work, right above the tail. And you should know when, if you start to combine the other concepts I've taught you in throughout all of my master classes right on this channel, that you can, now that you're in, you can start playing the color game. What's the color game? Green bar, eliminate the next green bar, boom, add right there. What's the color game? Green bar, eliminate green bar, boom. Another green bar, eliminate green bar, boom. Another green bar, eliminate green bar, boom. And you can continue to do this as long as you want. And there you have it, guys. Fat green bars that are removed, okay, far away from the key two moving averages, your 20-period moving average and your 200 on the 2-minute time frame. It's over. All right, that's your play. You know where to strike, you know when to strike, you know how to protect yourself. You even know what to do after that, which is to start playing the color game. Right? There are other aspects of the trade, guys, that we're not going to cover now today, but there are 7 parts of every single trade. You're supposed to know all 7 parts and know how to handle all the 7 parts of a trade. And once you know all 7 parts of the trade and how to handle all 7 parts of the trade, the rest of your journey is just experience. Taking a trade, getting through all 7 parts, boom. Taking the trade, getting through all 7 parts of the trade, trade 2. Taking the next trade, getting through all 7 parts of the trade, 3. And that's building the right experience. This concept that I'm going to teach you here, this technical technique, is called what I call the no follow through technique, or the no follow through concept. And this is one, not the only, but this is one of my key ways to finding major turns in the market, major tops, major bottoms. Okay. Now, because the market has been in a downtrend for quite some time, I'm going to teach this concept to you from the bottom up. But remember, everything I'm teaching you is applicable in the other direction as well. All right. So always remember, everything I teach you can be played both long as a concept, buy, and short as a concept, sell. All right. But since the market has been dropping, I think it's more relevant for us to really do the deep dive from the bottom up. Okay. Because that's where we are right now. All right. So no follow through. This is the key to finding major bottoms, major, not small bottoms, because there's a way to find small temporary bottoms too. But this is the major turns. You want to be an expert at knowing when a major bottom is in place in a stock, in the overall market, in a cryptocurrency, whatever you trade, boom, this concept is going to be your best friend. All right, let's go. The no follow through concept. All right. Okay. So this is no follow through event number one that I want you to be aware of. And I'll have to pick it apart a little first so that you thoroughly understand it. The no follow through event that I want you to be aware of comprises of a fat, sizable red bar. Now, you can have, some wicks on either side of the fat bar. It doesn't have to be perfect like this. This is just a drawing, right? So you can have a little wick at the top, a little wick at the bottom. What I'm saying is that there's a lot of freaking red in the bar. Okay. So this is not a normal red, it's a sizable red. Okay. It's more than the little green that you see as the second bar. It's sizable, a sizable red bar. But if you look at this event that I'm showing you here, that I've drawn here, is that this bar has 0 red after it. Now, let me tell you why that's significant. A fat red bar, write this down, has like an 80, 83%, 82, 83% follow through rate. Think about this, guys. 82 to 83% of the time, another red bar follows a fat red bar. That's how reliable these bars are. Do you know how wealthy you can become in the markets with something that has an 82% success rate? It's like being right almost 9 times out of every 10. And sometimes 10 times out of every 10. That's how you get the 8.2 times out of every 10. And we've run studies on these. All right. So there's an 82+% follow through, meaning that most of the time another red bar follows a fat red bar. So a lot of traders then understand, Oliver, now I understand why you dive into fat red bars on the short side, because 8 or 9 times out of every 10, you're going to get more downside. All right. So that's the first thing I need you to understand, that 82% follow through rate. But in this case, this is the exception. There is no follow through. The next bar is green. There's no additional red. Like what? Then the next bar is green. What? Okay. That's still not the special part. The second special part is that the red bar to the left gets totally removed. It doesn't matter which green bar does it. It could be the 5th green bar, the 10th green bar, the second green bar. It could even be the first green bar. But the key is that the red is completely recouped and the green goes past the beginning of the red. It takes out the high of the red bar. So the 3 things that I need you to know that makes up this event: fat red bar, 1. 2, 0 follow through, no additional red, 0. And 3, the green completely erases, completely recoups, completely neutralizes the red by trading above the red bar. That is a major bottom. The odds of the low of that red bar being revisited or even broken is extraordinarily low. You have found a major bottom in your stock, in your option, in your bond, in your market, in your index, in your futures contract, in your cryptocurrency. Doesn't matter. powerful no follow through event. Now, remember I told you that a fat red bar has like an 82, 83% follow through rate, which means that it should produce another red most of the time. What I have found in the markets, traders, is that when something is supposed to happen but doesn't, it's big the other way. Let me repeat that. If something is supposed to happen, because it almost always happens that way, this fat red bar is supposed to produce another red bar, but it doesn't. I have found that when something with a high probability is supposed to happen, but doesn't, and the opposite happens, the opposite direction is big. It's almost like the expectation is so overwhelming that the reversal shocks everyone and catches everyone off guard, and a complete unwinding has to happen. It's almost like what is commonly referred to as a short squeeze. When so many people are short the market, I want to buy, because every move up squeezes the shorts and they have to actually unwind the position. All right. So this is almost like that short squeeze scenario. It usually kicks off a very, not all the time. Nothing is all the time, guys. Just understand that. Nothing is all the time. Not all the time, but a lot of the time it kicks off. That low is a very significant low, and the move up is usually quite significant. Now, this is the version 1 of the no follow through event. Version 2 is this: a little follow through, and then boom, we take it out. So the first, remember, the first had 0 follow through. There's not a single ounce of red after that fat red bar. And the second version is, okay, got a little follow through, but is that really follow through? If all of the red eventually gets taken out. All right. So version 2 is allowable. A little follow through, like a little slip through of the red, then boom, all of the red, the little one and the big one, is completely annihilated, completely neutralized. It is the neutralization that I think is also very important not to miss, guys. It's not just that the fat red bar produced little to no follow through. This is little follow through, and this is no follow through. So you'll often hear me say little to no follow through. It's because of these two scenarios: little follow through, no follow through. Okay, so we're talking about the little follow through now, but please don't miss this important point here. The complete removal of all the red is very, very critical, and that's your buy point. It is the removal of the red where you know, now I have zero doubt, this is the bottom, I'm going in. Now you can, guys, I'm telling you, you can pick any financial item, any stock, any market. Go back in the past. You can pick any time frame, intraday time frame, daily, weekly, doesn't matter. And then you can go to major tops and major bottoms in the past. And you're going to see a lot of them, not all of them, a lot of them started just like this. In fact, why don't I just show you that? Why are we playing around? Why don't I just show you that? Let's do it. Okay. Boom. Okay. What do I have up here? All right, here's Bitcoin's daily chart, right? Got a daily chart of Bitcoin. Look at the lowest low on the Bitcoin chart. Now we're looking at a 15-minute. No, we're looking at in 1 hourly time frame of Bitcoin, right? Just take a look at it. I rest my case, right? Look at the fat. Look. Remember that story, guys, I used to tell you? I said I had a childhood friend, right? I had a childhood friend uh, who he stuttered. He had stuttered, and there were certain things he would have to say multiple times. We would always tease him, but whenever he wanted us to look at something, he said, look. He couldn't say the word look just once. He had to repeat it like a machine gun. Look. And it was a speech impediment. We never let him live it down. Even to this very day, we've never let him live it down. He always had to say things like 4 or 5 or 6 times. So oftentimes, in his honor, that is what I do. So here's what I want to do here with you. Take a look here. Give me a second. Fat giant red bar, 0 follow through, guys. Now, don't confuse these reds as follow through. What I mean by follow through is that there's no lower red. Do you understand? Follow through is a continuation of the red. These reds are not continuations of the red because they're not lower than the red, the initial red. So this marked the major bottom, fat red bar. Boom. There is your entry price. And what's that sound? That's it. I want to see people do that for me. Can you do that for me in the comments? That's a fiat counter. All right, we make the fiat and we convert it to Bitcoin, right? Just do it for me in the comments. I want to see. That's right, guys. It's gonna kill me. All right, okay, guys. So look. So here, boom. All right, you want to see another one? We can stay on the same chart. Look at this one. Fat red bar. You see the fat red bar? Should I move it? Let me move it to the right a little bit here. So you have this fat red bar, right? Fat red, but one little follow through. That is why you'll often hear me, as I mentioned before, little to no, little or no. This is no follow through, and this is little follow through. Little or no. All right. And here's the little follow through and okay. And here's the no follow through. All right, guys. I'm going to stop teasing him now. It's crazy. It's crazy. And guys, I'll tell you, it even happens a lot in these micro scenarios. Like you see this bar here? This is a troublesome bar. This one, let me blow it up a little bit for you. This one here, that's a troublesome bar right there. But it has no follow through and it gets taken out. Boom. You see that? Okay. Red, no follow through and it gets taken out. This no follow through concept, guys, I will tell you this. When I discovered this, it was like a freaking bright light that completely changed my trading world. It was one of those, and there have been a variety of these moments, but it was one of those moments that caused a paradigm shift in not only the way why is my framing is off here? But it was one of those paradigm shifts that changed not only the way that I saw the markets, but I mean, it just exploded my opportunities. Like I started seeing these things all over the place. And it made me realize like, oh my God, like this concept gave me the ability with to be able to with confidence say that's the low. Do you understand how valuable that is to have that ability? Most people on planet Earth cannot do that. Do you know that if you ever got good at that, that you'd become the $1 million person? How many firms would hire you and pay you millions for your ability to say that's the low, that's the top? This is extraordinarily valuable, traders. And so, like when I got this, it was like, wow, oh my God, you know? So there you have it, guys, the no follow through concept. Now, remember that this is also, don't forget that this is applicable on both sides of the fence, as it were, right? So, you get these fat green bars, right? That don't really follow through. Look at a little follow through, and that's the top. And then a fat red bar, no follow through, and that's the bottom. It's freaking crazy, right? So there you have it, guys. Very valuable technical concept that it's my belief, based on my experience, that if you find a truth in the markets, something that is true, and you build a tactic or technique around that truth or based on that truth, okay, that truth should be true no matter where you take it, no matter where you go, high, low, left, right, this market, this time, that time. If it breaks down when you move it somewhere else, then it is not a truth. Truth does not change because you change from one market to another. Now, or from one time frame or another. When you've found a legitimate truth, it can be universally true no matter where you go. Okay, this is very important to understand. So, every tactic that I teach you is a universal tactic or technique, okay, across all time frames and all markets. Traders, listen to me carefully. 72% of all new highs, this is moving to a new high. 72% of the time that's going to fail. The same on the downside. 70, it's actually a little bit less, but it's so close that we might as well lump it in as well. 72% of all moves to a new low rally back up and fail, at least temporarily. Now, this is not generally understood in the market arena, believe it or not. Despite the fact that this is factual, most market participants are very unaware of this unless they've gone through specific training by someone or with someone who understands these probabilities and these statistics. This is the cause of many trader losses, their lack of understanding that a new high is more likely to fail than it is to follow through and continue to make new highs. And the same is on the reverse. Now, everything I teach you, I'm going to largely teach you from the long side, traders, okay? I'm going to largely teach you from the long side, but everything I teach you is applicable on the downside as well, in reverse. So please always remember that. It's just that people understand from an educational point of view better when I teach it from the long side, but it's always applicable in reverse as well, okay? So here's what we need to go over. 72% of all new highs and new lows fail. Let's understand what I mean by a new high, all right? So I'm going to draw on this slide. Let's say a stock has run to the upside, a very decent, steady multiple bar movement to the upside. So this line to the upside represents a multiple bar move to the upside, okay, on your chart. All right. Now, your stock then pulls back, several bar pullback, okay? And then leaving behind its former peak. You can't have a former peak, right, until you have a pullback. The pullback is what creates the former peak or the prior high, okay? So we need a strong move to the upside or a decent move to the upside and a pullback. The peak is the prior high. What I mean by a new high is this: a move back past and through the former peak. What I'm telling you is that 72% of the time, this will fail. This new high will fail 72% of the time. Okay. And only 20, let's say 28% of the time, okay, you're going to get continued follow through on that breakout to a new high. Now, what do I mean by new low? Just the reverse. You've got a strong move to the downside or a decent move to the downside. This is a multi-bar move. It's not one bar down. It's multiple bar down movement. Now, you need a retracement in order to have a prior low, to form a prior low. What I'm saying is that 72% of the time, this new low will fail, meaning that there won't be follow through 72% of the time. 28% of the time, there will be. So now, if this statistic is true, and it is, by the way, but if it's really true to you, it is better to actually go the other way on every new high, meaning you bet against a new high, you'll be right 72% of the time, and you bet against a new low, and you'll be right 72% of the time. You're going to lose 28% of the time on average, but you'll win 72% of the time. And as long as those losses are kept in control and tight and relatively small when you do lose, this by itself is a winning strategy. Going against, being the contrarian and going against every new high and every new low. Now, I'm not suggesting that you do that, but I am making you aware of how powerful a 72% reality can be, that it can make you automatically profitable by doing it every single time. As long as you keep the times that it doesn't work contained and small, you're guaranteed a winner. When you find a truth, this is a market truth that is high, like this one, 72% is extraordinarily high. I've mentioned to you on a variety of occasions, traders, that there are trading algorithms that have an accuracy rate of 36, 38%, and they make millions of dollars a year. With an accuracy rate as low as 38%. So that means that basically for 62% of the trades are losing trades. Only 38% are winning trades, yet the algorithm makes millions of dollars. Guys, I know this intimately because I created a relatively small army of trading algorithms back in 2002. And I had 14 algorithms that were micro trading the markets basically throughout the entire market day without any human intervention whatsoever. Each one dedicated to a specific technique or style. And this was a tremendous amount of work because these algorithms required constant tweaking by my techs and my programmers and things of that nature. And I eventually let them go because the nature of the market sort of changed in a way. But I am telling you that the vast majority of the trades were not winning trades. They weren't, but the non-winning trades were so micro and so small that the winning trades would basically extraordinarily overpower the losing trades. And so my point is this: if an algorithm can be
as inaccurate as only winning 38% of the time, yet making millions of dollars. Imagine a concept like this that has a 72% reality, right? So this is a market truth, and I don't want you to forget it. 72% of all new highs fail, and 72% of all new lows fail. Okay? Now, let's move on to the next thing. This leads us to having to know our proper percentages. All right, so I'm going to teach you proper percentages, which are going to give you, these percentages are going to give you the ability to determine what's the likelihood that this move to a new high is the 28% that's going to follow through versus this is one of the ones that are going to fail. So we need, in order for me to bring you to that ability, to create that ability in you to be able to say, that's one of the 28% that's going to keep going. Now, this is one of the 72% that's going to fail. In order for me to get you there, we have to first understand our percentages. Okay, so let's go. The first percentage I want you to understand is 33%. Now, what does this mean? This means that if we have a move to the upside, boom, and the pullback that creates the top is only a 33% or less pullback. Top third, that's 33%. Middle third, and bottom third. If your pullback stays in the top 33% of the strong move to the upside, this is likely to be one of the 28% that keeps going and going and going. All right? If you have this strong run up, let's take the next percentage. Okay? And you pull back, and this pullback, it passes the third mark, but it doesn't pass the 50% mark. This has odds of being one of the 28% that will keep going. So the first two percentages in terms of pullbacks, in terms of the stock rallies and then starts dropping again. If the drop is milder than the rally by 1/3, and then we break to a new high, that new high is likely to keep going. If the stock runs up in the second scenario, pulls back a little deeper than 33%, but does not really exceed the halfway mark, that still kind of falls into the 28% camp of breakouts to new highs that can keep going. But the second two, maybe not. Let's take a look. So the next percentage is our 66% mark, right? Stock rallies. We drop past the 33%. We pass the 50%, and we drop into the 66% zone. Now, when this attempts to rally, if this manages to break that high right there, boom, that's likely to fail. That deeper than normal pullback has already run a freaking marathon before getting to the breakout point. You see, by the time this stock comes from 66%, runs past 50%, runs past 33%, by the time he gets to the new high, this stock is like this. Boss, Did I run well enough? You see what I'm saying? And this suckers so many traders in because alerts go off across the entire world, traders. Alerts, oh, WXYZ, new high. Alerts go off across all trading desks all around the world. And a lot of times traders are just automatic buyers of new highs. Now, this piling in at this tired point is what creates the possibility of a violent reversal back to the downside, because as this tips back below the new high point, everyone who piled in here is a loser. And what do losers do? They start piling out, applying even more pressure. The deeper this drops, the more they're losers. And so they join the other side to become sellers. Okay, adding additional sell pressure onto the failed new high. Okay, now guys, listen, there is a video, a very important video that I did. Maybe it's 2 years ago or something like that. It's called, I think it's called The Trap. I'll make sure on this recording that I put the link to that video. But this is what I'm explaining here is that trap play that I do a deep dive in. And when you know that this is happening, you can actually turn this failure into money in the markets. All right. But you have to understand these percentages first. Okay. So by coming back from a deeper than normal pullback, by the time the stock reaches the new high point, it's already spent. It's almost like a gun that's already used most of its ammunition to get there, or a marathon runner who's run a marathon, and the traders that don't know that the stock has already run a marathon are jumping on board and betting that the stock is able to run another marathon. Now imagine how terrible a marathon runner is going to be after running 27 miles first as a warm-up to run a 27-mile marathon. Not going to happen. All right. And this is what you're dealing with a 66% pullback that moves to a new high. It's going to fail. All right. Most of the time. Now, everything, I have to say this, everything I teach you is never can be 100%. All right. You're going to find 66% pullbacks that keep going. I'm not talking about something that's perfect. We can't find that. But 8 times out of every 10, you're going to be right with this. Okay. And that's all you need to make a living in this market, finding things that are 7 to 8 times out of 10 right, controlling the times that they're not right to small losses, and just repeat them over and over again. The rest becomes a numbers game. Okay? All right. Now, I've got to cover the 100% scenario, which is very similar to the 66%. So in the 100% scenario, right? What happens is that you pass the 33%, you pass the 50%, you even pass the 66%, and you come all the way back to the beginning of the whole move. You see? All past the 66%, you come all the way back to the beginning. You retrace the whole movement. So let's make a clean version of this 100%. We're covering the 100% version now. So we've rallied, we've pulled back, we've passed the 33, we took the 33 out, we've passed the half, we've taken the half out, okay? We've even passed the 66%, we've taken the 66% out, and we've gone all the way back to the origin area of the initial move to the upside. This is your origin area. That's a 100% retracement. If this manages to turn and be strong enough to get all the way back, I am telling you, 8 to 9 times out of 10 in this case, that's a powerful failure. If the stock is tired by the time it gets to a new high after a 66% retracement, imagine how tired it is after a 100% retracement. Now, as I've mentioned, there's a special video on this event right here. All right? The trap play. That's what I believe the video is called, the trap play. All right? I'll make sure I have a tag in this in the recording version of this so you can easily click on it and go to that if you want a deep dive into how to profit from this failure. I just don't want you buying it first. All right? The next step is, the next step after you get used to seeing this happen over and over again, the next step is to go to a place where this becomes one of the tactics you play. The failed trap, new high, the trap, the new high that is a trap for traders that do not know what I'm teaching you here today. All right, because this is a very reliable trading tactic here to play this to the downside. And so there are our percentages, guys. 33%, 50%, 66%, and 100. These can produce new highs and new lows. These will typically be your traps, be the 72% that fail. These will be the 28% that work, typically. All right? So I hope that makes sense. Hope that makes sense, guys. All right, so let's move on to the next thing. Now, okay, we have to know how to take this information and use it to assess the odds. All right. Now, this is slightly a different, it's the same concept, but I'm going to take the concept and go a little bit deeper with it, the percentage concept I just explained to you. Let's say, for instance, on the left-hand side, your stock has dropped to the downside. Now, I want you, this can be a one giant fat red bar drop, or it can be a multiple red bar drop, like boom, 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 like that. So it can be one fell swoop, or it can be boom, 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 boom to the downside, right? One fat bar or multiple bars down doesn't really make that much of a difference. All right. So now I want you to understand that if this stock, the odds of this stock, if it bounces, the odds of it getting all the way back to the 100% mark, we know that if it does and breaks out, that the odds are that it fails. But the odds of it getting there is 1 out of 10. I need you to understand this. You will see a stock come all the way back to the 100% mark after a strong, powerful drop. That'll happen 1 out of 10 times. So it's important to understand these numbers. Okay? Now, let's go to the next percentage down, which is, you know these percentages now. It's 66%. What's the odds that we get? So the odds that we get all the way to the 100 is 1 out of 10. But what's the odds that we get not to the 100, but the 66? All right. That's going to happen 2 times out of every 10. Interesting, right? Okay, let's take our next percentage. You should know what that is. That's the 50% mark now. Okay. What's the odds of this stock bouncing back to the 50% level? Now, something interesting happens here. Something interesting happens. You jump to 6 times out of every 10. Uh-oh. Wow. You're more than 50%. This can bounce back halfway 6 times out of every 10 times, 10 attempts. All right? Very important to know. You'll understand why in just a few moments. Then we take the last percentage we know, 33%. What's the odds that we bounce back? Let me do that in the same color. And we bounce back a third. Eight to 9 times out of every 10. It's like 8.5. That's why I say 8 to 9. That's crazy. That's crazy. So most of the time, these things are all going to fail or pull back at these levels. Okay? But the odds, I want you to understand that after a powerful drop to the downside, the bounce up gets a lot of people suckered into the bounce up. Oh, it's oversold. Not if that's a violent drop. The odds that you get to 33%, 8 out of 9 times out of 10. The odds that you get all the way back to halfway, 6 times out of 10. But it starts to drop to 2 times out of every 10, bouncing to 66%, bouncing to 100% is 1 times out of every 10. And the same thing on the reverse side, right, guys? So we have a strong power move to the upside in the form of 1 bar or in the form of multiple bars. It doesn't really matter that much. And let's put our levels in, right? There's the 33%. Here's the halfway mark. There's the 50%. Okay. Here's the 66%. And the 100%. Now, the odds of this stock getting all the way down after it's strong is the same. It's 1 out of 10. Okay. We're talking the same thing. 1 out of 10. Hope I'm not in the way with this. The odds of us getting to the 66% is 2 times out of every 10. The odds of us getting all the way back to the 50% jumps quite nicely to 6 times out of every 10. And the odds that we get at least a third pullback, the odds really go ballistic to 8 to 9 times out of every 10. Okay. Now, as I've taught you, a move up from here is highly likely to make a new high and keep going. The move up from here is also not as high, but it's still high enough to make a new high and keep going. The attempt from here, if it got to a new high, is likely to fail, but the odds of it getting to a new high is very low. So what is this likely to do? Do this, rally and drop. This one, the odds of it getting all the way back to 100 retracement or new high, if it did, it's going to fail most of the time. But the odds of it getting there is very low, 1 time out of every 10. So what is this likely to do? It's likely to bounce and boom, make a new low. So the new lows that work come from these levels. Okay? These concepts of knowing how to assess the odds of something that is bouncing and likely to be and being able to say this bounce is not real. Do you understand how powerful that is, guys? All right, look, let me show you this. To be able to say, boom, this bounce is not real. We're going lower. Do you know how valuable that is? Boom. How did you know that? All right. This bounce is not real. Boom. How did you know that? All right. Oh, I'm doing the wrong one, actually. Sorry about that. I'm sorry, I'm doing the green bar. I should be doing the red bar. To be able to say this bounce is not real and should now move to a new low. The ability to do that is so powerful and profitable. The ability to say this bounce is not real. We're going to new lows. Do you know that that is like a money machine? It's very powerful. To be able to say this pullback is not real. This is going to new highs. Boom. To be able to say that we should make new highs from here. Boom. To be able to say this move is not real. This is a fake out move to the upside. We're going lower. Why? Because you hit the 66% level. That bounce should fail. To be able to say, this bounce is not real, I don't believe it, it's going down again. Why? Because we hit the 100 level. Boom. Knowing when to say, we're going higher. I know it's pulling back, but we're going higher. And to be able to say, you know what, this move to the upside is false. I'm not getting caught in that move up. I'm not placing my faith in that move up. We dropped to the 66% level, more or less. No, that move is false. This move down here, this move is short-lived. Boom. The ability to do this is scarce. It's rare. As simple as this is, it's extraordinarily powerful and it's scarce. It's one thing to be powerful, but everyone has access to it. No, this is powerful and very few people understand. It's simple, it's powerful, and very few people understand it. It's crazy. Now, I often get the question, guys, Oliver, if I often get the question, Oliver, if you keep teaching people these things and more people start understanding them and playing them, won't it ruin the tactic or technique? No. Not if we're playing very solid things with institutional sponsorship. We're not talking about playing junk that's lightly traded and only a few people trade it a few times a day, no volume. We're not talking about junk like that. We're talking about things that have hefty daily order flow, lots of volume, institutional sponsorship. I like to play things that have institutional sponsorship, which means that institutions play every day in this item. And so as long as that's the case, these things will always work more often than not. And it doesn't matter how many of us, we're fleas in the grand scheme of things. Doesn't matter how many fleas jump on board the elephant's back. It doesn't stop the elephant from walking to the water and jumping in to take a bath. All right? Doesn't matter how many flies or fleas jump on the elephant's still getting to that water pond or whatever. All right? And so, no, it's not going to change anything. Now, very quickly, guys, I don't want to confuse you by having this image straight up and straight down. Most of the time, it's going to be like this. So your stock's going to drop like this on a slant and bounce up and fail. bounce up, and fail. All right? Bounce up, and now, no, I'm do this wrong. Bounce up and fail. Bounce up and fail. Okay? But if we get, guys, to the 66% level, this is likely to fail, but now it will likely not make a new low like these. The new low comes, guys, look at this. This is a very important concept. The new low comes from a 33% bounce up to a half 50% bounce. But if you break past the 50% and get close to that 66%, now this drop is not going to make a new low. If we get all the way back here, remember, if this makes a new high, that fails. But even if it gets all the way back and fails, this failure should not make a new low because it's now working on this side of the numbers, this side of the move. So now we have to go to this concept. Wow, this moved all the way back. This is so strong. Now I have to start dividing this into my percentages, and this should move higher. This should move higher. This not so much, and this not so much. I hope that wasn't too confusing. But guys, these are the powerful concepts one by one that I teach my traders to operate off of, to perfect, to continuously practice, to hone, to get down. This is a tool in your trading tool belt. This is a powerful concept that will, is something wrong here? That will lead to, oh shoot, it's because I didn't do this. I understand. I got it now. I got it now. All right, guys, so let me go over this again. I don't want you to mistake, right? I don't want you to mistake the straight up. Let me do this again here, guys. I don't want you to mistake, right, the straight up and down image here. That's to teach you the concept. In most cases, you're going to have this concept play out more on a slant. So your stock is going to drop to the downside like this, right? Your stock is going to drop to the downside on a slant like that. Now, here's what I need you to understand. If we bounce after this drop like this, if we bounce, but peter out anywhere under that 33%, the odds are high that we move to a new low. If we bounce up to and get past the 33%, but we bounce to the we bounce up to the 50% mark, the odds are still good that we drop back to the downside. Let me just make sure everything's okay here. What's up? What is that? Is everything okay? Are we okay? You're giving me a call. All right. I guess my team called me by mistake here, guys. Sorry about that. All right, so guys, if we bounce up to the halfway mark, we're still likely to drop and fail to a new low here. All right? Slightly lower odds than the 33%, but still high. If we bounce all the way back to 66%, now look, this move is still likely to fail from here, but now the move down is not likely to make a new low. It's likely to bounce off one of these levels back to the upside. You've gone past the 50% mark. You see? So now, in a way, this strong move must now be looked at like this. And from here, we have to now break this into our percentages and say now this pullback is likely to move higher from here because we got all the way back to the 66% retracement here. It's still likely to fall back, but this fallback is temporary now and will not likely go to a new low like these are likely to go to a new low. From these levels, you're not likely to go to a new low. So if we move back up here all the way to the 100%, we know this is likely to fail. We know this, okay? We know that pullback is likely to fail. But one thing I want you to know is that it might fail, but it will likely not fail all the way back to the 100% level. Okay? Now, this is going to be made a lot clearer to you if we go to charts, and that's what I want to do here, all right? Just want to make sure everybody's okay because I don't see your comments right now, but I just want to make sure everyone's okay. So let me take a look at you here. And take a look at you. All right. Make sure everybody's good. All right. Okay. Are we good? The screen still wasn't being shared? You couldn't see the charts? All right, good. All right, fantastic. Okay, now, what I want to do now is I want to take you to charts. Okay, I want to take you to charts, and I want to make this clear on data that happened today. All right, I like to use today as our charting examples a lot of times, all right? All right, so let's go to some charts, all right? And I'm going to show you how this concept works in real time using today's data, all right? All right, so let's do that. Boom. Okay. Now, can we do this with Apple? That's the first thing we're looking at here. Yes, we can. All right, so look. Remember, don't forget what we're talking about. We're talking about this move up, and then we're going to do our divisions, right? And we're going to see on a strong move up, does it do this? Does it do that? Does it do this? Okay, these different levels, right? So here we go. Look at this move up. Look at this move from this low here. Boom. Now, it starts pulling back. You see that pullback? What percentage is that? What percentage did it maintain? Here's your halfway. All right. Here's your 66%, right? Here's your 100. And here's your third, 33%. Boo! I'm sorry if you guys have cats nearby or whatever. I know they just jumped or what have you, but boom! Gotta love it. I love it. All right. So you see that this pullback, this is the strong move I was talking about. All right. This was the strong move. Now, here, if you look at this, look, now let's take this move itself. Move up. Now, let's break it up. You see that? We drop. Boom! You got the new high. Because the dip, the pullback didn't break into the lower levels. Okay? Now, When I want to show you something, I'm going to show you this on the reverse side now. Let's take a look at the reverse side here. Look at this move up this morning. This is this morning. Look at this is the 18th. Okay. Now look at this move this morning. We move up. Now do your divisions. We break through the 33%. We break through the 50%. We break through the 66%, and we get all the way back to the origin of the move. Okay? Now, this is not likely to make a new high. It got far, though, but then failed. Okay? But not so fast. Let's go over this. This is very powerful, guys. This is very powerful. So check this out. This move all the way back down. Remember, this is that red movement I drew for you on the slide, you see? Now, we're going to take that and we're going to divide that into the divisions, right? Now, look at this, guys. Check this out. If we rally here, we're likely to drop. If we rally to here, we're also likely to drop to new lows. But if we get all the way back to the 66%, we're likely to drop, but then go higher. You understand? All right? Because we got to the 66% level. Now, check this out. All right? So here is that red movement down. All right? Here's that red movement down. Now let's do our divisions. You should be able to do this in your mind. You don't have to draw on the chart. If drawing on the chart helps you, that's fine. But this move up see, if it moved here and failed, we're going to new lows likely, right? But it didn't do that. If we move to here, all right, we got all the way to there. We got to there. Well, it actually kind of partially failed here, but we got all the way back, not all the way to the top, but now the next failure or the next drop should not go all the way down. We should react off one of these levels. Boom! To the upside again. So what I'm trying to show you is that you can move from one angle down to an up angle up. So we were first measuring this drop. But depending upon how far the rally gets, we might have to flip that to green. This got so deep into the red that now we give this the benefit of the doubt and we start splitting this up into the appropriate levels. Boom. Okay. And this move now becomes the new move that you must break up. It's going to take a while for you to get used to doing this. So we break through all of these levels, which means that this next rally is likely to do what? Fail somewhere before the peak again. All right? And so this is how you take this percentage concept and come up with potential probabilities. All right. So I see them all over the place. Look at this. I always look for the beginning of a move. So here's the beginning of a move down, right? Now I want the move to be sharp and hard, not just a gradual move. It has to be sharp and hard. Then if I break this up into the percentages, look at where we bounce to And I'm like, we're going to new lows. Boom. Right? See? And that's the concept, guys. That's the concept. I'm going to take a look at one more here. I'm just looking at the things that I like to trade in the morning here. Here's something interesting. Look at this strong move up this morning. This is this morning. So here's the origin of the move. Boom. That's a powerful move this morning. All right. Now we got to break this up. We largely stay in the top third. Do you see that? I mean, this little blip, we can ignore that. That's a little overshoot. But boom, we're likely to go to new highs. This is that 28% of the time you're going higher because the stock can't get past that top third of the power move. All right? Very fascinating. Now, if we look at this move, let's take a look here. Let me go here. So from this sideways, I would say the origin of this move is here. All right. We're going to take that big move and divide it into its pieces. You know, we're dropping here, we rally, but we fail here. All right. We fail to make a new high, which is fine. And this comes into another concept. This is called the midday doldrum period, guys. And your failures are higher in the midday doldrum period, all the way to basically 2:30 Eastern.
Everything that I teach you is designed from a psychological point of view. It's designed to help you determine two very important points in the market. And that's all you really need to know how to do. To be a very decent market participant, you have to be able to go into any market in any time frame and find 2 points. They're transitional points, right? So the 2 points are, where does fear stop and greed begin for the first time in a while? So let's say, for instance, you have fear is running a race. Red, red, red. Fear is the color red. Red, 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 right? And then when does red stop or fear stop and pass the baton to greed? And when does greed take the baton and start running again? And now greed is running the race with the baton. Green, 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 green. There's a certain point where green runs out of steam and passes the baton back to fear. Now, those are the 2 points. It's the baton pass. That's all trading and playing the markets is about. Learning how to identify the baton pass between fear and greed. Fear and greed. Now, here's the thing. There is a moment when fear passes the baton to greed and greed grabs the baton. There is a moment, it's ever so brief, where both have the baton. One eventually lets go and the other starts running. But that moment, that split moment where fear and greed both have their hands touching the baton, what does that moment look like? I am telling you, traders, there's only 7 pictures. There's 7 pictures that represent this moment. And that's all you need to know, those 7 pictures. There's 7 pictures that represent the other switch. 7 for this one, 7 for this one. 7 for fear passing the baton to greed, and 7 for greed passing the baton back to fear. And if you know how to identify those 2 moments, listen to me carefully. Those 2 moments exist in every single market in the world. on planet Earth. I don't know about other planets, but on planet Earth, every single market has those two moments. Now, those two moments are, and the runs in between those two moments are driven by two dominant emotions, fear and greed, right? Fear and greed exist in every single market. And a lot of people say, well, Oliver, if you teach too many people, you're going to ruin everything. I'm here now. Don't teach anymore. I want to be the last one you teach. It's ridiculous, because fear and greed's not going anywhere. Anyone who feels like if someone knows, if too many people know what I teach, that it's going to ruin what I teach, doesn't understand that it's based on fear and greed. And no matter how many people are doing this, we haven't changed the dynamics between fear and greed in hundreds of thousands, if not millions of years. When is the color green in the market? We know that movements up create the color green. When does the color green? When is green not to be trusted? When do you not trust the bull? When do you not trust the move to the upside? When do you not trust the color green? I'm talking about trading for a living, where you go home flat for the day, comfortable, richer than you were richer than you were when the day started, and now you go enjoy your life. This is what I'm talking about. All right. So look, I'm going to take you through a trade of mine today. All right. I played Alibaba. All right. What you are looking at is a 2-minute chart. Every bar represents 2 minutes of trading. What you are also looking at is two moving averages. The blue is the 20-period simple moving average, and the red one is the 200 simple moving average. Now, I don't consider a chart unless it is accompanied by these two moving averages. You can't show me any chart in the world, no matter what market it is, no matter what time frame it's in, without these two moving averages. If there was a market for trading mother-in-laws back and forth, I would say, show me the 20-period moving average of the mother-in-laws and show me the 200-period moving average of the mother-in-laws. No market in the world, no time frame in the world without you showing me these two moving averages, right? Permanent fixtures. There are others I use, but these are the two anchors. Do you understand what I'm saying? All right. That is a good idea, right? A market for mother-in-laws. Cool. All right, good. Look, so every bar is 2 minutes. Okay. Now, what you see here is Baba gapping down quite sizably this morning. Okay. Now, if you look carefully at the first bar, what did the first bar do? It opened and ran up. See that? Now, we don't see the other bars yet. I had traders buy this. I'm like, what are you doing? First of all, we're under everything. We're under yesterday's data. Here's yesterday's data. We're under yesterday's data. So yesterday's data being above us is a ceiling. We're under a declining 20-period moving average. Worse. And we're under the major 200-period. We're under everything. We're underwater. The entire market is in a bear market. This little tiny salmon called Baba is trying to swim upstream against an entire market that's in a bear market. Overhead data from yesterday, a declining 20 and a flat and an overhead 200. How far do you think this little tiny salmon trying to swim upstream is going to get? You don't trust the green in a freaking bear market. Say it for me. Green is not to be trusted. Now, when I say this, it doesn't mean that there won't be some days where you look back and realize, wow, this was a day that green, if I trusted green, I would have done well. Such is life. But we're not talking about the exceptions. The exception doesn't make the rule. I am tired, traders, of you guys trying to bring me the exception all the time. Yeah, but Oliver, what about this time? What about this one? I'm like, yeah, but that's one time out of 10. So do we want to major in the minor one, or do we want to major in the major one? Do we want to focus on the thing that happens once or twice out of 10 times? Or do we want to focus on the thing that happens 9, 8, or 9 times out of 10? Why would you bring my attention to the exception? It doesn't make sense. All right? There's nothing in life 100%. Well, death and taxes. But aside from that, there's nothing else that's 100%. So don't bring me the minor. Don't bring me the exception. I don't want to see it. I don't want to give my attention to that. It's ridiculous. All right? I had traders buy this morning. I'm like, what are you doing? It's going to collapse. And boom, the first bar fell after traders bought, only to knock them out at the low. All right. And if you look at the price range to the right, guys, that's a fairly big drop. So we're talking about a drop of over $1.20, $1.30, 1,000 shares is $1,300 gone, just like that in seconds. All right. Now, go inside of these bars, right? Go inside of these bars. So first BABA moves up, then collapses, then it moves down. Boom. Now it goes up again. Watch it go up again. Watch it go up again. All the way to here. You see that? And there were traders, not mine, but I saw them in the market. Traders buying BABA here because it broke to a new daily high. So here's the mistake a lot of traders make in the markets. They buy new highs, all right? And I've taught you that 72% of all new highs fail. So here's the new high right there. And here's the failure. Boom! Slammed again, trusting the green. Okay? Now, so you have to be able to look in between the bars, guys. Look in between the bars. Maybe I should do this with a different color. So watch this. Look at the movements. First we go up, then we go down. Boom! Then we go up again, then we go down. Boom! Then we go up, 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 up. Boom! Then we go down. Then we go up. Boom! Then we go down. Then we go up. Boom! Then we go down. Now, I know I might be oversimplifying things just a little bit. My main point is that up or green is not to be trusted in a bear market, and especially when you're in a bear market and under everything. Now, remember what everything is. Everything is data from yesterday. All right. This is data from yesterday. The 20-period moving average and the 200. 3 items. Data from yesterday, the 20, and the 300. You're underwater. So you have to look at it like this. These 3 things are going to bear down their force on the stock. As the stock tries to rally to meet them, it will be knocked back. Do you understand? Okay? Got this so far. Now, nothing's every time. I feel like some of you think there's some magic to this where we can find a 100% accuracy thing. That doesn't exist. We find a thing that has an 80, 70, 80, 90% probability. That's the zone, 70 to 90, 70, 80, 90. Everything I teach you has a 70, 80 to 90% reliability. All right. Now, how do you play this? How do you play then if you don't trust the green? You simply wait for red to wipe out the green. You wait for a red to wipe out a green. Now, it is best to wait for a red to wipe out a green and finish and then go. Let me show you. So here's a green. Let me show you a green. Here's a green. I'm going to draw this green, green. This is going up. Everything is above it, right? Everything is above it. So it's going up, boom, and you're waiting for a red, boom, to wipe out the low of a green. And it is best for most of you, it is best to wait for this red to finish. Not for all of you, but for most of you. Wait for that red to finish. And if it stays there and closes there after its 2 minutes is complete, boom, you dive into that bar and you protect yourself above that bar. If that red bar is the reason you're diving in with your capital, then why would you be willing to still want it if the market takes away that bar? The very reason for our trade is the red bar. So our stop goes above the red bar, because if the market trades above the red bar, our reason is gone. It's removed our reason. It's removed the reason for this trade to live. So we kill the trade. Okay? So here's the thing. If we see that Alibaba, green, 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 neutral, when is the first time a red eliminates green and stays there until the red is complete? Right here. Boom! It eliminated this green. Now, you can use just the body. You do not have to incorporate the tail if you don't want to. You can, but the traders that get the best entries tend to use just the color, just the body. As long as this red closes under the low of that green, boom! And wait, bring it from all the way over here, guys. All right? Tell my kids this. Bring it from all the way over here. Send that missile in. Boom! I just like bombs. I like aggressive trades. I don't like the boom, Oliver, boom, I'm in Baba. Boom, boom, Oliver, I'm in Baba. No. We bring it all the way from over here. Boom! I want Baba to shake. Do you understand? And there's nothing to fear, because in reality, if you're in this bar here, or you're in the very next bar right at where that bar finished, and your protection is there, all right, what's the worst thing that can happen? All right, you get out here. That's like falling off of the curb on a sidewalk. Do you understand? It's falling out of the basement window. All right, you might scratch your knee a little bit, but it's not freaking life-threatening, right? Okay? And so this is a bold play. There's nothing to be timid about, nothing to be scared about. All right? We accept our loss if that red bar is taken out and move on. That's life. Okay, now, you can continue to do this throughout the morning. When is the next time a red bar drops below the low of a green bar and finishes there. All right? Right here. Boom! There's the low of the green. So your first one was here. Your second one was there. All right, when was the next time a red bar drops below the low of a green and finishes there? Let's do it. Let's come from over here. Boom! Right there, right? All right? It's not rocket science. This is not higher mathematics, guys. This is 12-year-old trading stuff. When is the next time? Right here. Boom! When is the next time? Right here. Boom! Guys, sometimes I'm freaking embarrassed. I'm embarrassed at how simple this is. I'm also sometimes embarrassed that I really don't have that much to teach you. If you give me 2 days, I can teach you every single concept that's reliable in the market. I only need 2 days. It's not like I need 4 years like university. All right? That's scam. I don't need 4 years to teach you this. I need 2 days because it's basic stuff. And it's simple, but it's powerful. And it appeals to the common sense. Something underwater in an overall bear market is not to be trusted if it tries to go up. This is very basic in a bear market. You understand? We don't trust this green. 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 We don't trust any of this. Now, when is the game potentially over? Give you a little valuable nugget. When some people think it's over when the stock breaks through the 20. No. It's not over. It's not over when the stock breaks through the 20. It's over when one bar takes out 2 red at the same time. When can you find a green bar that wipes out 2, not 1, 2 at the same time? That's a green bar that is telling you, I'm getting ready to take over here. And if you look at it, it's here. Well, it's really here. So this is the first sign. And then you have another one there. This green bar took out 2 red ones at the same time. That's telling you the bulls are starting to gain power. This green bar took out this red bar and that red bar at the same time. The reason why I like this one the best is because there's 2 right next to each other. How many legs in this down movement? Here's 1. Here's 2. Here's rest. Here's 3. That was a long one. Rest and 4. And what you'll find that I taught you is that after 3, you're close to a bottom. And so here's your third leg. And look at what's starting to happen. Green is starting to aggressively wipe out red. That's when you know you're bottoming, at least temporarily. And so traders, guys, look, this is not rocket science. There is this tendency, right? Why can't I get this to work here? There's this tendency that almost all humans have, for one reason or another. It is, in modern times at least anyway, this tendency to believe that if it's too simple, it must not be valid. There is this idea that it has to be complex. It just has to be more, Oliver, to this than a red bar eliminating a green bar. No, it's not. It's freaking not. People think it's got to be more than if it moves up in a bear market, don't trust it. It's got to be more complex than that. No, it doesn't. It doesn't. Most things in life that are very powerful are very simple. It is when you start tinkering too much, it is when you start convoluting things too much that things get messed up. Like governments, organizations, they can get too clustered, too clunky, too complex, too many divisions, too many people, too many projects going on, too many moving parts. This is a simple game. It's so important to understand this. If you feel that you're going down this rabbit hole of, I need to add this and add that, stop yourself, because this game is a very primitive. It's primitive in nature. Think about this. Markets only do three things. They go up, they go down, and sometimes they go sideways. That's complex. The three movements need some convoluted, high-level, complex approach. Now, if the market had 2,119 different directions or movements, maybe you'd need something complex for that. It's got freaking three. The market's got three movements. And if you take out the sideways movement and look at the sideways movement as nothing more than a resting period between the two major movements, the market only has two movements. Now think about this, guys. The market has two movements, up and down. The sideways is just a break, a water break between the two major movements, right? The market has two colors for the most part, red and green. The market has two dominant moving averages, the 20